Hello, everyone, and welcome to today's Blockworks webinar, Liquidity, Fragmentation, and Capital Efficiency in Crypto Markets. Today's episode is made possible by Fireblocks. I'd like to invite our speakers to unmute their lines and turn on video. During the webinar, please submit your questions to our speakers through the Q&A function at the bottom of your screen. We'll save some time at the end of the discussion to answer these. The session will be available on demand, and all registrants will receive an email once the recording is live. I'd now like to turn the event over to Blockworks market strategist, Byron Gillum. Byron, please go ahead.
Thanks, Jane. So I want to start just with a shout out to our sponsor, Fireblocks, who is making today's conversation possible. Fireworks provides a digital assets platform for its customers. Their solutions include custody, settlements, DeFi access. If you're a crypto native, you probably know them. There's a high probability you're already a customer. If you're a TradFi person like myself, you can kind of think of them like a Swift for digital assets and also an FIS for financial technology. But check out their website. They do an incredible array of things, including a lot of stuff related to today's topic, which is liquidity, fragmentation, and capital efficiency. We've got 3 industry practitioners that deal with these things on a daily basis to talk us through it today. Do you guys want to introduce yourself? Tell us where you are, what you do. Stephen, you want to start us off?
Sure. My name is Stephen Richardson. I'm based out of Singapore. I head Fireblocks APAC business and also lead our broader product strategy and our business solutions, our internal advisory service for financial institutions. I've been with Fireblocks now for over 2 years. Prior, I was an advisor for the company, and then within fintech and blockchain since 2017. So looking forward to the conversation today.
Great, thank you. Anand, do you want to tell us what you're up to?
Sure. Hi, my name's Anand Gomes. I'm co-founder at Paradigm. Paradigm is a institutional liquidity network. We basically provide institutions with a single point of access to liquidity, multi-asset liquidity on demand. We're known for options. We're about 25-30% of the global options market every day. And, we happen to work with folks like Josh, who are one of our clients. And I'm based out of Singapore.
Great, thank you. Josh?
Hey everyone, my name is Joshua Lim. I work at Genesis Trading. We're one of the largest and oldest OTC dealing desks for crypto. We, broadly speaking, have 3 verticals, around liquidity and spot and derivatives, around custody and holding assets on behalf of our customers, and around lending and borrowing as well. We're part of a larger group of companies called Digital Currency Group, which owns other familiar brands like Grayscale and a certain other media company that I won't mention on this call. But we're one of the largest kind of liquidity providers in options. That's my current role, is I run the derivatives business at Genesis, and work obviously pretty closely with Anand and with Stephen as well at Fireblocks. We're a big customer of theirs.
Excellent. Okay, so as said, the topic is liquidity, fragmentation, and capital efficiency. Stephen, maybe would you be willing to just kind of define that for us on a high level? Like what are the issues around liquidity, fragmentation, and capital efficiency in crypto?
Yeah, I'm happy to kick it off. So, I think as folks come into this market, right, given maybe experience within the equity space or other traditional asset classes, typically you're really looking at, FMI, financial market infrastructure that exists, that centralizes where liquidity is, right? New York Stock Exchange, Euroclear, Deutsche Börse, et cetera, where you can go, banks are connected, and you can really trade on a centralized venue. In the digital asset space, you have a number of players that exist, global exchanges from Asia to Europe to the US to South America, that all provide access to the same assets, Bitcoin, Ethereum, Tezos, Stellar, a number of different assets where they can trade. And so, you also have market makers, you have OTC desks, and a number of different folks that basically can provide you access to liquidity, which leads to a highly fragmented market, right? There's no really single source for liquidity and really accessing the market. Rather, they're multiple, and your ability to really execute across these multiple domains can mean, the ability to get towards best price execution. Now, firms like Genesis and others that have been in the space for a long time have really optimized this, but it's a big hurdle for folks as they come into the space initially. The second thing is from a liquidity perspective, as you think about your, exchanges in the crypto native space, they started on a vertical basis, right? So they built everything from the underlying custody stack through the central limit order book and all the settlement and clearing or clearing and settlement that occurs. And so there's this idea of pre-funding in the digital asset space where you send funds to exchanges, you then trade, you settle, and then you remove those funds. In traditional spaces, this idea of pre-funding is kind of limited by the idea that you have prime brokers and other components or participants within the space that don't really need this basis, right? There's, credit systems that allow you to trade without pre-funding. And so the combination of these two things, at points in times for new entrants can be really difficult, and the ability to really manage these two components can lead to, higher revenues or the ability to really optimize your trading strategy. So it's something that's a critical component for folks that are trading and executing in the market to think about today.
Very impressive summary, Stephen.
Sorry. So Stephen, you said that Genesis optimizes for, was it best execution? Joshua, do you want to tell us how you guys do that?
Yeah, for sure. So I think Stephen kind of hit a lot of the highlights on the development of market structure for our industry. Thinking about how the asset classes evolved from mostly like a retail, kind of a fragmented retail-driven market to where it is today, where there are plenty of institutional investors that are trying to deploy capital in very large size into crypto. There's a need for these, I think the types of service providers that are on this call to really channel that liquidity and sort of provide the same level of institutional service that most asset managers are used to in other asset classes. So, for Genesis in particular, the way that we operate is we think of ourselves more as a prime broker function, which, in practice, that kind of means we provide financing. We help people to sort of figure out a way to deal with the fact that crypto is mostly a fully funded product on the spot side, and hence is not very capital efficient. And so financing positions, financing, execution across multiple venues, things like that. And then sort of on the trading side and liquidity side, sort of figuring out the best way to route that order flow. A big theme of this session is just around how fragmented the market is. And it kind of feels like it's becoming even more fragmented these days because of the entrance of things like DeFi venues, which are becoming a much larger fraction of total liquidity. So, you kind of do need desks that have the ability to sort of execute through, centralized exchanges, through OTC, electronic liquidity providers, through derivative venues, where, still those derivative venues are trading, 10, 20x the size of spot venues. And then now through kind of DeFi platforms, which like those platforms can also be pretty capital intensive, right? Because they require you to fully fund those trades. So yeah, those are kind of the things that we think about, and how, our value add is really more around optimizing the financing and the execution piece.
So Anand, what do you see as the biggest challenges in these kinds of things, and liquidity and capital efficiency from your perspective?
Yeah, so I think I have more of sort of a nuanced answer, or not an answer, really more like a comment. I think it really depends on asset by asset, right? And I think it stems from the fact that, like, I think fragmentation in crypto is more of a sort of a feature than a bug. And decentralization obviously just like compounds that like manyfold, right? So, which is going back to why Josh's comment, why it feels like fragmentation is only increasing, as there's sort of this explosion of all these DeFi protocols across multiple chains. So, it's clear that we're moving to a multi-chain world. And so if that's the case, this problem is only going to get sort of larger, right? And so, I think that's one of the sort of the long-term bets that we had sort of written down when we started the business, that, that decentralization is going to drive fragmentation, and there's going to be this sort of hybrid future of formalized sort of formal centralized and decentralized markets, but what's going to matter is really liquidity, and then the ability for firms to sort of have that liquidity on demand. Now, even within, and that's a catch-all statement, but it actually differs quite a bit. Like if you look at options, for instance, it's not so much that there is a fragmentation of liquidity problem. There just isn't enough liquidity to begin with. There's only a couple of venues and that really trade. Like Deribit is obviously the one that has, I think, 90+% of global volumes and liquidity, and we're a big component of that. But but in that it's for options, it's slightly different than, say, for futures or spot. And when we look at things like futures and spot, then sort of the things that really drive the fragmentation are, liquidity, the relative liquidity, and then the fungibility of the assets, right? And spot is obviously very fungible. So, you would think that, these things would consolidate, but they don't. There's an explosion of venues. So, so I think it really, the problem really is for assets that are fungible, and liquid. You really need a connector, a single point of access, where it sort of limits, it sort of reduces, it abstracts away all the complexity of connecting to these platforms, and getting the best price, when you want it, how you want it, and without compromising for sort of costs, price, size, or clearing preferences. And that's sort of what we bring to the table, especially if you're an institution. Our hyper focus is sort of bringing this liquidity to you, in the shape and form that you want, without you having to make a compromise on any of these sort of price, size, execution, and cost and immediacy, right? Immediacy is a big one too, because like waiting is one thing, but like when portfolio manager wants size done, they want it right away. And so that sort of connecting function is what the Paradigm Network is about, but on things that are sort of, but on the other side of it is things that are sort of not liquid to begin with, such as options. That's where we build, it's sort of, we take a more grassroots approach there, instead of just connecting. There's connecting the market is part of it, but also how does price formation occur? That's where the execution protocols come into play as well. And so there we take a sort of a much deeper sort of approach in solving that problem. But the ultimate problem is liquidity, and on-demand liquidity, right? It's just how you approach it, sort of is sort of changes depending on asset to asset, if that makes sense.
Yeah, I mean, maybe I'll comment really quickly, right? I think, I think when we're talking through our prep session, there was a question around, is fragmentation good, right? Is fragmented liquidity a positive thing or a negative thing? I think one of the interesting things is that as you think about centralized liquidity venues, right, there's this idea that, folks with, massive amounts of money and the ability to co-locate and do all these things really optimize themselves in a centralized basis, right? The ability to kind of think through that. But, we work with firms that started with, 2 or 3 folks, and the ability to have infrastructure to connect to platforms and OEMS providers, and then to be able to deploy whatever capital they had across a range of venues in a very optimal way, enabled growth, right? And I think the idea of this fragmented liquidity basis, where you can look at exchanges all over the globe, right, that have different prices, different products, different asset classes, I think is a really good thing, right? And so one of the things about, I think, crypto space that is unique is there's a sense of like the ability to piece together all these infrastructural components leads to a certain level of merit, which then leads to a certain set of growth, right? And I think that speaks to the onus of crypto in general, right? That I think is a really good thing, right? And, you're seeing, regulation in places like Germany with what BaFin is doing around tokenized real assets kind of take a step towards opening up liquidity, enabling some level of fragmentation and direct trading that I think is a good thing for broader market structure, not necessarily, this ability to have centrally cleared and centrally managed ecosystems. So, I think there's always a question of, how do you, what are the right infrastructural elements that need to be put together to take advantage of what I think crypto offers on a unique basis in the way that the original construct was, and then how do you then execute on that in a purposeful way? So, I think that's always a good thing. It's a complicated thing, right? I think it takes people that are smart and diligent and have a vision for, understanding where liquidity across the globe might exist and how they can take advantage of it. But I do think it's a certain thing that's unique in our space. And doesn't necessarily exist in my mind in centralized spaces.
I struggle with that idea a little bit, just having been in TradFi for so long, where the entire focus is getting, all the liquidity in one place, concentrating liquidity. But where do you stand on that, Joshua? Was fragmentation a feature or a bug?
I think it's an inherent, property of crypto, an emergent property maybe, that because it is by nature decentralized, it's global, it's democratizing in a way. Like, people are constantly going to innovate and create new venues to trade crypto, and that's always been true from the very beginning of the asset class. It's not something that can be regulated out of existence, I think, because I think crypto has a tendency to just flow towards the easiest way of execution. That's why you see, so much volume going through DeFi these days, because that's kind of where the resale users are, and that's where they live, and they're comfortable with using, MetaMask to execute, swaps and things like that, even if they're paying, 90 bips to do it. I think that, there is a distinction here where it's like there are some parts of the market that are going to be more less fragmented and more transparent and regulated, and particularly like thinking about the US sort of derivatives market, and the way the CME is sort of like consolidated volume there. That might be a reflection of the fact that collateral requirements in the derivative world make it difficult for people to have collateral sitting in multiple venues and trading across all of them right now. And I think that probably will continue. I mean, I think the trend generally in the regulated space is more towards consolidation and sort of aggregation of liquidity in a single venue. Like, I guess Coinbase is a good example of that in the spot space for US customers. But I think in the sort of the unregulated world, it's going to be more fragmented, and I think that'll persist for forever, basically.
And keep growing, I think, pretty massively.
Yeah.
It seems to grow with every new layer one, and I think SushiSwap is on like 12 different blockchains now. It's kind of mind-boggling. So Anand, how do OTC markets solve for this, or how do they deal with these issues?
Yeah, I mean, the way we sort of explain, the value we bring to customers is quite straightforward. It's more sort of an, there's the order books exist. Let's use a centralized exchanges for an example. Order books exist, but order books don't solve for all use cases, right? So, for example, if you're an institution and you're trading sort of either large size or something sort of complex, such as a call spread or tied up trade, where you're doing options and futures together, there's certain sort of cadence in terms of your execution that you would prefer, right? If you have a large size trade, you're not just going to go in the order book and type in buy 1,000 Bitcoin worth of options, right? So that's where the OTC markets come in, and sort of the set of execution protocols that solve for these use cases therefore need to be slightly different, right? Because the order book fulfills or is really good for small types of trades or sort of small size trades, but that's where RFQ comes in, right? And so one of the protocols that we've had success with is what is known as RFQ. We've sort of built on that, and now we have version 2 and version 3 of that protocol. But ultimately, it's a different type of protocol that sort of aids in the price discovery and execution of these sort of large and multi-leg, what we call complex trades, and that is about 30% of the options market today, and most institutions value that. And the third piece is, of course, when you're trading something very large, you want to avoid market impact, right? When it's this idea of not destroying the order book, and so block trades or the OTC space, gives you that, because it's sort of off exchange execution, but then on exchange clearing, and so you sort of get the best of both worlds. You get the margin management and the fact that your money is kept in the settlement from the exchange, but you get sort of the off exchange execution, and that's the piece that we sort of solve for. Now, I keep using the word exchange, but we're sort of agnostic. We're using the exchanges to clear, but just as easily we can clear or settle using the blockchain directly. And in fact, in the first half of next year, first quarter, actually, we'll be sort of getting into clearing directly on the blockchain, and specifically on an L2.
Okay, well,
can I just tag on what Anand said? So I think Anand specifically referring to kind of OTC trading in the sense of like large blocks that are cleared, either on chain or through exchange accounts. I think our business is more focused around bilateral trading that is completely off exchange or not recorded on the blockchain or visible in sort of exchange data, right? And I think there's a need for that as well in the market. So just to give you an example, right? Like there's certainly a lot of sort of macro firms or sort of liquid crypto funds that are positioning tactically for certain events, and they don't necessarily want to kind of broadcast their positioning in the market. So they might trade those positions in an OTC way or bilaterally in some sort of option contract that wouldn't get translated to any sort of market visibility. So that's like one use case. And then the other use case is around sort of, there's a lot of funds out there that need to, liquidate positions or build positions discreetly. And that's pretty difficult to do in crypto, given how thin some of the markets are. Your footprint can be very visible. Or, if you're doing stuff on DEXs, obviously you're subject to like MEV type of attacks. So that means that, what you really want to do is like find a good partner. And I would volunteer, like we're a pretty good partner for a lot of people, where you really just want to have a trusted kind of market intermediary, right? To step in there. And also you may not want to broadcast that your fund XYZ, notable, venture firm in the space, like is active in a certain name, right? For many reasons, like for relationship reasons, among others. So you do need to sometimes like sort of have some sort of intermediary that can stand in, that can operate for you on a principal basis. And that's like one of the functions of a lot of the OTC dealing desks in the space.
Yeah, the other one is sort of obvious one is also just market access, right? Some funds just can't trade on overseas exchanges. And so, guys like Galaxy and Genesis, have those relationships and can provide that market access for them pretty directly, and they take on the risk. So, that there's like bilateral OTC and then exchange OTC, right? If you can think of those two segments, and Josh's business faces customers in sort of the bilateral way, and then we have sort of the listed OTC market, if that makes sense.
What is the distinction there between bilateral and exchange OTC?
Bilateral just means like, XYZ, let Josh sort of jump in here, but effectively it's, hedge fund A wants to trade with Genesis, and effectively, you're facing the counterparty. So Genesis provides the price discovery and execution, but then also they settle with Genesis, right? So if it's a derivative contract, there's a series of contingent future cash flows. If it's a swap option, whatever, and they're settling, back and forth with each other. Usually, it's governed by something like an ISDA or some sort of agreement that governs the transaction. That's known as bilateral because it's between sort of two people. Our space is sort of listed OTC. That means when somebody finds liquidity execution on Paradigm, for instance, like Genesis, for instance, would come in and source liquidity on the platform. They can trade with a host of different participants, but then once the trade is matched effectively, they clear using the exchange. And so the exchange sort of steps in between. And so their counterparty is now the exchange. So you don't have to worry about the counterparty risk of the individual firm that you traded with, because ultimately you will face the exchange, which in this case would be Deribit or whatever.
Which of those two markets is bigger?
That's a good question. I think I would, venture a guess. I would say the listed market is bigger. But Josh can sort of give you more color because he plays in that space.
Yeah, I think generally speaking, probably the bilateral OTC volume is maybe something like 50% of what you would see on total exchange volumes. So there's, obviously a lot of that flow gets hedged using exchanges, in one form or another. So
wow, 50%. That's a lot.
Yeah.
Yeah.
So Stephen, you must see a lot of this because I think you guys provide solutions for all these kinds of things.
Yeah, I mean, look, we look at it more on the technology side, obviously, right? We look at, how we enable firms like Genesis to interact with counterparties on a bilateral basis, and really how you can use things like the network to secure, settlement obligations, right? Our job is to say, these guys are great at what they do in terms of, best price execution, in terms of providing deep and liquid markets and all those other things. We focus really on saying, how do we enable like efficient settlement, right? And how do we ensure that, settlement is secure, that it can be done in a distributed manner in the way that it should be, right? It's, in cases like this, there's no real centralized entity to ensure clearing and settlement, right? So, how do you make sure that the asset gets from point A to point B? So, there's no man in the middle attacks, there's no cybersecurity threats, there are none of those things, and those things are mitigated. At the same time, we're also thinking about how does a firm like Genesis interact with different exchanges, right? And allocate capital to those different exchanges and settle efficiently on those different exchanges, whether they're using Paradigm to be able to really, take advantage of, price discovery and on these listed markets, and then settle on an exchange like Deribit, right? The allocation of capital, the ability to efficiently transfer that, the ability to manage treasury and manage operations becomes critical in doing that. And so if you have kind of one platform that potentially is acting as a hub for this, right, and is basically enabling you to access and settle efficiently in both those different spaces, I think we see that as a significant benefit, right? And so a lot of firms really are taking advantage of both those things as they build out both their OTC desk and kind of their market making liquidity provision, but also how they execute within, the broader ecosystem and on exchanges and between other large counterparties, right? And that's where we play in the market. We're not a financial services company. We don't trade. We don't do those things, right? But we provide what we think is like the underpinning technology to ensure that those guys can effectively do what they need to do in the market. And by creating integrations with, platforms, like Paradigm and others, right, to make sure this is like very seamless, efficient, and optimized, right? That's our job. So really, when you think about it, it's like this fragmented liquidity exists. You need counterparties like Genesis to be able to provide seamless, liquidity and optimize in a way. You need Paradigm to be able to effectively manage all the fragmentation in the market and where it exists and how you access it. And then you need Fireblocks, at an underlying level to make sure you can settle those assets between counterparties. And, folks, build different models to do that. They may have their own custody infrastructure. They may use Fireblocks in combination with that. Our job is to be flexible in that way. So, that's where we focus and kind of the connectivity that we have.
Okay, so I think so far we've mostly talked about the fragmentation. I thought maybe we could zero in on the capital efficiency issue a little bit. So am I right in understanding, Joshua, that you kind of abstract that away for your customers?
Yeah, in some sense, right? So we're either doing some sort of execution where we pass through kind of our pricing that we do on exchanges, or we're doing some sort of execution where we wrap that all up into a risk price that like a principal risk trade, basically. Yeah.
And then so do you must have to move capital around a lot to all of the different venues that you trade on?
For sure.
How many different venues is that, just as a guesstimate?
It's a lot. It's maybe, it's definitely more than 30-ish, something like that. We're constantly kind of retooling which venues we want to focus on because, liquidity moves around a lot in crypto, and the league table for exchanges changes a lot. And even now we're seeing DeFi is becoming a much bigger part of the mix. And certainly some assets only trade in DEXs and things like that. So, moving money around and capital between different venues is difficult. I think that's why Fireblocks has just really dominated a lot of the kind of dealer, the sort of infrastructure that dealers are using now. A lot of it relies on providers like Fireblocks. So I think from our perspective, the aspects of managing that, the coin movements and sort of the administrative and reporting aspects of it are very, we're very happy to kind of delegate it to the tooling like Fireblocks. And the security aspects too, very, very difficult. That's a hard problem for a lot of institutions, especially the ones that are kind of starting to experiment more in DeFi. It's like, you can't really use the same set of tools that you would as a retail user when you're running a trading desk. So I think these are all things that we're really trying to put best practices around right now.
Yeah, I mean, capital efficiency. I mean, this is a huge problem in crypto. And nobody has seemed to solve it yet, and rightfully so. It's a very difficult problem to solve. Like in let's say commodities or any of these old traditional markets, the concept of an FCM is pretty powerful one, right? You park all your money with a single point of access, and they give you access to all these markets, and they cross margin and portfolio margin, all of that stuff is sort of bundled in. Lending, borrowing, everything is there. That doesn't exist in crypto, and so there's the degree of sort of capital inefficiency is very, very high, and nobody seemed to be able to solve it yet. A, because obviously the degree of fragmentation is so high, but B, also from a regulatory perspective, it's quite icky to touch, right? Like no person wants to, at least no US person for starters wants to be, providing margin and be able to, access all these sort of overseas markets, right? And so it's an extremely difficult problem to solve. I ultimately think, DeFi, even in that's why I think DeFi is I think these solutions will come more naturally in DeFi because of how open these ecosystems are, and you just see that the rate of innovation is like permissionless, right? People just say, okay, this is a problem, I'm going to go fix it. They'll create a smart contract. That smart contract interacts with 15 different venues. Now, of course, those venues are not as liquid as CeFi venues, but if you're making the bet that these venues will ultimately be a significant portion of, let's say, a percentage of CeFi volumes, then man, these problems are going to be solved there, and they're going to be solved in a very, very sort of seamless way compared to all these other issues that CeFi markets have. So yeah, I mean, it's a problem, but I don't ultimately think anybody in CeFi is going to solve it. And so we're at least our bet is that somebody in DeFi will definitely solve it, or at least we'll start to see some meaningful progress towards that front. And there are some people out there already doing it in a small way, but yeah, so this is just my 2 cents.
Yeah, I mean, look, I maybe another piece, right? The landscape on centralized exchanges is not built for collaboration. Let's just be honest, right? I mean, they're structured to be highly vertical with custody underneath it, centralized central limit order books, and then settlement, right? They don't want to move assets across. The idea of collaborating, the idea of Coinbase collaborating with Binance is a non-starter, right?
Yep.
So or Deribit, right? Because in essence, you want to capture volume and encapsulate volume in one place. Like that's how they derive revenue. So really, it's the way we look at it is can you have faster speed to execution without centralizing risk, right? And the question becomes, can you build tools and applications from a technology perspective that allow you to lock capital off chain allocate it on chain, settle, and immediately unlock that capital and redeploy, right? And you're not, solving the cross margining issue, but you are solving, right, the speed of allocation issue, right? And in days where the blockchain is congested, margin calls are proliferating, right? Your ability to really lock that capital up instantaneously and deploy it on exchange and settle is, let's say 10 steps forward in that basis. I think there's a role, and I think what's really interesting that we're seeing in the traditional space is you're seeing like CSDs and other infrastructure that was like legacy, looking and saying, what can I do from a credit intermediation perspective or from a default fund perspective that might operate across, different exchanges, right? And I think, why I absolutely agree with Anand that it's going to happen first in centralized spaces. I think folks are looking and saying, where am I going to get disintermediated in the traditional markets, right? Given, the tokenization of other assets and using basically, digital assets as a frontier case for what they anticipate will be tokenization of equities and broader distribution across the globe. So I think you're seeing like these FMI infrastructure say, can I use digital assets? Can I enable like large exchanges to interact in a pool, allow cross margining and efficient settlement and centralized clearing and settlement, right? And then use that as a base case for what I think will be some emerging trends on other asset classes, right? And we're seeing those conversations, happen all the time. So, it's going to be a really interesting, in my opinion, like 2022 into the early part of 2023 will be a very interesting basis for like the kind of use cases that will start to solve cross margining across centralized exchanges. I don't think you're going to have participation happen at the exchange level itself. It's going to be someone with somewhat significant balance sheet and ability to really put that balance sheet to use, right? And then offer it for, I think, a set of institutions at first. So, that's my kind of view on where the market's going based off of conversations we're seeing. But I think DeFi is going to be a place that allows that to happen at let's say a broader level with other folks stepping in at kind of larger sizes.
We're incredibly bullish about DeFi. I mean, I can't stress that enough. DeFi is the way. It's like I've gone from being sort of cautiously optimistic to like I couldn't be more excited. Like it really is, and especially in the last 12 months or so, and not even the last 12 months, like I would say the last 6 months, right? With L2s becoming sort of showing the way in terms of performant exchange things. You can have things that are performant and scalable, and I think that seeing that in operation in companies like firms like DYDX just have done a fantastic job of actually going out there. They did the right thing, went out there, bit the bullet, took risks, built on StarkX, and wow, they have an amazing exchange now, right? So I think there's things that we look at where we say, okay, this is possible now, and this is not just possible, it's possible and it scales pretty seamlessly. And so if one person has done it, it's only a matter of time before people catch on and learn whatever sort of the small barriers there are in terms of learning, building on L2s and so on and so forth. But it's very clear to us that like this is the future, and this is where we need to be.
Let me just, we're about 6 minutes away from Q&A, so let me just ask viewers to get your questions in now. The last 10 or 15 minutes will be dedicated to Q&A. Joshua, where do you see cross margining and at the moment, and how are people going to solve for that going forward?
Yeah, I think it's going to be piecemeal between sort of on-chain solutions and sort of the kind of an internal ledger-based approach. So if you think about how maybe like a traditional prime might do it, is they sort of have these relationships with various liquidity providers and various exchange venues, and they sort of internalize the capital requirements needed to support all the open positions across. They sort of net that risk off internally. So that's an approach that we're sort of taking as a prime in crypto. So we often have counterparties that are engaged in all kinds of sort of like margin long short positions with our spot desk. they might be engaged in sort of lending and borrowing activities or repo type activities with our Genesis Capital business, and then they might also be trading derivatives, right, where they're hedging, the assets that they hold with us in custody, or they might be overwriting, for yield, things like that. So if we can provide that capital efficiency through netting those positions and the risks off internally between all those different verticals at Genesis, that's something that clients are pretty happy about. But I think, that's us as one player in a much larger ecosystem. And where the market's going to go is, people are going to want solutions where you can trade with us, you can trade with another dealing desk, you can have your own exchange account at Finance, you can, have your sort of DYDX account where you're running sort of these perps on chain, and you want to be able to net off your offsetting risk everywhere. And so that's like a harder problem, like one way that we kind of deal with that is like, because on-chain activity can be relatively transparent, sometimes we work with counterparties directly where we set up sort of API access to exchanges. We set up, the ability to track their DeFi positioning, and then we aggregate all of that and try to figure out, what their net exposure is. And because that's, pretty good visibility, it's basically real-time risk visibility as a result of everything being on chain. That gives us the ability to sort of like net off, different types of exposure and possibly give people better capital treatment. So yeah, that's sort of that's how we're sort of dealing with it ourselves. I think eventually the whole industry has to come to a conclusion where, we build tools and conventions that we all accept as an industry, various dealers, providers like Fireblocks, and even like communications and clearing platforms like Paradigm. It'll take a while though, I think.
Yeah, I think one thing that sort of to complement what Josh is saying, I think there's a couple of it's pretty obvious that the world, there is no sort of we're not converging in terms of sort of the future, right? Like it's sort of multiple things are happening, multi-chain. It's going to be a hybrid future, and ultimately it's about providing value to your clients or whoever you're serving, right? In some way, like you have to find a way to serve them in all the ways that they interact with these markets, because it's not going to be a one way where you say, oh, I want to only park my money here. Well, it's sort of not possible to do that. And so if it's not possible to do that, then okay, cool. What else can we do to ease your, and as Steven said before, that's like, there's multiple problems, right? There's problems in terms of like the cross margining, but then there's also problems in moving money from exchanges. I think Fireblocks has sort of solved that to a large extent. And so there's problems at different levels, and customers are doing many things on many venues. And I think, firms that take that holistic view of like, okay, there's all of these things happening. How can we add value to clients in whatever way is possible today, given that, the tech constraints we have. And so firms that do that, I think will do extremely well.
It's incredible to me, coming from TradFi, that all of these things are being solved by people just writing code for it. And there's no regulator figuring it out for us. The market is solving for all these things, and it's really amazing. Anand mentioned DeFi. Steven, I'm curious, how much engagement are you seeing from customers in DeFi?
Yeah, it's a big part of our business, right? So, at Fireblocks, what we've done is developed a solution, leveraging our wallet infrastructure to allow folks to securely move assets to DeFi within the same governance constraints that they do for centralized exchanges, right? It's, typically when you looked at how you engaged before, right, you use MetaMask or, other alternative tools, but you didn't have a level of governance in terms of who could allocate, from what walls could they allocate to, what smart contracts could they allocate, and venues could they allocate to. So it was really a risk to say, I'm a large institutional fund that wants to allocate funds to DeFi. I have all these governance components in place for my normal business, but hey, like I'm going to allocate on MetaMask. Like that was like only certain firms could do that, right? I mean, it was like significant oversight and a lot of risk, right? And so what we've done is develop solutions that allow firms to do that in a really strong way and a highly operational way. The other thing we're seeing is, there's a huge demand for that, but we also work with like folks like Aave. So, Fireblocks is leading the work around Aave Art, which is a KYC DeFi pool, right? Which then allows folks to leverage the technology behind DeFi, but do so in a way that, is, more regulatorily palatable, right? It's now you have firms that basically can understand that everyone within the pool, well, I don't know who exactly I'm settling with, right? The settlement infrastructure is still at a protocol level. I know at least everyone that's participating in that pool has gone through some level of KYC, right? And now you have market makers and others that can participate in that pool and then extend that out to other pools to generate additional yield, right? And bring that back in for the borrower or for the lend. But it does provide a basis. So I saw a question around like an FX dark pool. I mean, it's a very similar concept. You don't know who you're in effect kind of like settling against while you're in that pool or while you're utilizing it, but at least every participant in that pool has gone through some level of diligence, right? And so that becomes important, right? And solving these issues are things that our clients need, right? And are the things that they're demanding, right? And there's a big demand given the yield basis within DeFi for folks to be able to participate. And it's up to, folks like ourselves, right, to provide infrastructure that allows you to do that. So, it's a major area of focus for Fireblocks. We're building, lots of different things and partnering with lots of different protocols and applications out there to be able to really address that need.
Okay, I think that's an excellent segue into Q&A. We've got about 12 minutes left and a bunch of questions from listeners, watchers. One is on regulatory risk. Do you guys see a lot of regulatory risks to crypto trading and market structure? Is there anyone who would want to jump in on regulatory?
I guess I'll speak really quickly. I think there's a range of regulators, right? I think there's some really forward-thinking regulators like BaFin in Germany, MAS in Singapore. And then I think if you look at the US, there's a hodgepodge of folks that are fighting to be able to regulate crypto, right? SEC, CFTC, OCC. I mean, it's like, it's pretty crazy, right? So I think, BaFin put out a paper recently that was relatively bullish on DeFi and the capabilities that it allows. They've done a lot of things around tokenization and other things to basically clarify the regulations for operating in digital assets. Singapore and MAS have done the same thing, right? So I think you're seeing a big shift towards like these jurisdictions. FINMA is another one in Switzerland. You're seeing a big shift towards these jurisdictions. Others like Gibraltar or others, right? Where there's a single regulator with the ability to engage very closely with the crypto native market and digital assets in general. And they're creating and drafting regulation that I think doesn't necessarily stifle innovation in the space. And I think if folks take that approach, I think there's a really strong collaborative model that's been built that basically allows innovation to continue, allows firms that are engaging with regulators to grow their businesses, and allows a certain level of disintermediation that I think will come anyway, whether in a regulated context or a non-regulated context. So, for me, I don't think regulation is a bad thing. I think it's important for regulators to keep in mind there's this kind of innovation curve that's occurring, and how can they harness it, right, and participate in it, but then provide enough guide rails for folks to be able to operate within it.
Yeah, I would just echo that. We've recently sort of relocated to Singapore, partly. The main reason was the proximity to our customers and partners, but a huge reason was, the regulatory environment here is, it reduces uncertainty for companies, right? The government here has taken an extremely progressive stance, and in many cases, the progressive stance just means do nothing and engage with the community, and sort of make the community feel safe that like, okay, you're not going to get thrown in jail, if for building what are supposed to be financial products that advance financial freedom and all good things, right? So companies generally and of course it's also coincided with China banning crypto, and taking a sort of a very hardline stance there. So a lot of Chinese firms have started to move here. So Singapore is a great example of what I think a government that has taking, or just the regulatory environment here is just very progressive, and that's of course very encouraging, and that attracts more businesses here. Regulatory risk is also sort of a complicated thing, right? Like, what does it really mean? Does it mean in terms of like my business, shutting down a business? Then yeah, sure, definitely there's a ton of risk in that sense, especially for firms operating in DeFi, operating out of the countries like the US, where it's sort of still very unclear. But like, what does it mean for price? Every time China bans crypto, price keeps going up. So it's it's sort of, you need to be able to separate those two out. But yeah, definitely there's tons of risk, and I think companies, but generally speaking, I think companies have found a way to sort of navigate this in a manner in which sort of it continues to advance their core mission.
Are U.S. Funds or customers being disadvantaged by the regulatory environment, do you think?
Massively.
Yeah.
Massively. Like no U.S. firms can access overseas derivatives exchanges.
I think there's a lot of regulatory action that's being taken, for the sake of investor protection, which obviously is very important, right? If you look at the history of securities markets. But I think like the issue is like, you really have to balance that against innovation and allowing like this new product set to an asset class to thrive. And I think because so much is being invented constantly, you risk the possibility of like the US falling behind in terms of liquidity providers or market participants, or even just the degree of innovation and sort of technological progress in even like things like DeFi, right? Because the regulators are trying to like put too much of a kind of a legacy framework around it. Like, I think the frameworks have to really be updated, right, to account for things like, I think Stephen mentioned earlier, like things like risk-based scoring for transactions that you do through Fireblocks or MetaMask. Like there needs to be tolerances set, because in a kind of a pure DeFi, crypto on-chain world, you're not going to have full identity for every transaction like you would in an FX dark pool, where the dark pool providers KYCing everyone before anyone can participate. So it's like it's very different. I think regulators are still trying to catch up.
Okay, we've got a question about, oops, I've lost it. About fragmentation providing arbitrage opportunities, and whether those opportunities are going to be reduced in the future. I assume yes to both of those things, but I'd be interested to hear to what degree the opportunities are being arbed away and how quickly.
I'll let Josh take that.
Yeah, I think like traditionally, a lot of crypto firms that were quant firms or non-directional trading firms, like just basically thrived on the C5 or centralized exchange ARB spreads, right? Like a lot of those have gone away. I mean, not completely. I think it's more just like, the firms that have the best technology and the lowest latencies will win there. And it's very hard for other firms to compete. And also it's being crowded by like more traditional HFT players. So I think where a lot of people are going is just basically they're migrating out a little further on the risk spectrum, right? So either, doing things, I was going to say like extracting rents and stuff like that in different ways. Like instead of, providing liquidity and clipping bid offer as, the way of sort of generating P&L, like a lot of firms are now just thinking about forging partnerships with projects and being, sort of like a designated market maker and being compensated in other ways, like via, optionality in their sort of like incentives or like token grants, things like that, where you're sort of aligning yourself with projects and you're getting like long-term, more like equity type upside. So that's like an interesting thing that's happening in the crypto native world, where people are sort of migrating to these different hybrid trading investing strategies that are not really pure arbs. But that's kind of where more of the edge is going these days.
Does that mean that things are trading at different prices in different places less so than they used to?
I think so. Yeah, good.
Yeah, I mean, I think those sort of early crypto opportunities where things were trading at like, like very disparate prices across multiple venues, I don't think that exists anymore unless there's some sort of, dislocation that is localized, to that exchange. But I think generally those types of opportunities don't exist, or if they do, they get closed out really quick. But to Josh's point, like it's migrated to like, there's so much edge meaning there's just so much return, because with the creation of all this value from every project, from every ecosystem that new pops up, your sort of effort adjusted shop for like a market maker is like way higher for like market making a new token on exchange versus trying to scalp a few bips on trading against other very smart people on exchanges, right? So the obvious answer is I'm going to go to where there's less competition and spreads are wider. So that's, I think, what Josh was touching on.
Yeah. I mean, I also think the base infrastructure is improved, right? I think I was in the space in like 2017, 2018, pre-stablecoin, right? I mean, at the beginning of stablecoins like Tether, right, where you actually had a fund in fiat or was like crypto to crypto, right? And there were huge spreads between exchanges that had fiat capabilities and those that didn't, right? And then you had the introduction of stablecoins, and that kind of smoothed that away relatively quickly. I think you still see a little bit of a gap in my mind on a euro basis, to be a little bit honest, right? Like you have folks like BCB that are providing a little bit of an easier way to get that in across exchanges. But now I think when there's emergence of like a euro stable coin as an infrastructure perspective, I think it gets even more difficult, right? So I think there's been this like proliferation of underlying infrastructure, ability for folks to connect to multiple different exchanges, deploy capital, multiple stablecoin trading pairs that allow like immediate deployment into an exchange for kind of trade and execution basis. That I think has made it harder and harder to find those different components. So I think generally speaking, like the infrastructure is improved, right? And inherently, because that infrastructure is improved, it's either your ability to get closer to the new and emerging, areas for liquidity, right, that are happening all over the globe, right, or your ability to, like Josh was saying, find projects and other things that you can support at an early stage and see some of the upside for the work that you're doing there.
So I think we've got about a minute and a half left. I think maybe just as a last question to throw out there, is there anything in particular that you guys are like looking forward to? Is there anything our viewers should be paying attention to over the next, say, 6 months? Is it, I don't know, is it DeFi or new derivatives exchanges or L2s or something?
Yeah, for me, it's like on-chain derivatives, particularly like the non-linear stuff. I mean, obviously, DYDX has sort of pioneered like the linear derivative space on-chain with their layer 2 implementation. But I think like the stuff that like Ribbon is doing, or some of the newer kind of projects on Solana that are building basically structured products, or yield type of products using option primitives on-chain. That's like very, very interesting for us as a firm, and I think we think that's kind of where people are going to go, like retail is going to go to sort of get yield in the long run.
Yeah, I think I would definitely agree on that. I think it's also sort of the lowest hanging fruit with sort of a lot of yield, and so I feel like all the forces are aligning towards things like that taking off. And keep in mind that these are the same things that took off when crypto started earlier. Companies like Matrix Port providing things like what Ribbon provides today. So Ribbon is like the Matrix Port but on DeFi, and so it things like that. And I think the things that are the lowest hanging fruit will go first, and of course things will build on top of that after that. So yeah, I would definitely agree there.
Steven, you want to have the last word?
Yeah, I mean, obviously, I work for an infrastructure company, so we're mostly excited about what we think is going to be a broader proliferation protocols that allow regulated entities to engage in DeFi. I think we're seeing a pipeline and an interest that is pretty significant in that space. And we're seeing, firms want to offer products to retail consumers that allow them to really capitalize on this. And so, as folks continue to develop this, I think this is going to be a really exciting, basis for the market to look at. And I think there's going to be easier access for retail consumers to engage in DeFi through, institutions that they already know and trust. So that's a pretty exciting thing. It's a good thing for the market overall, and I think we're eagerly anticipating that on our side.
I think to steal the last word quickly, really, from Stephen. I think that's a key point about access via institutions that they already trust, right? So companies like Genesis, companies like us that already have these established distribution, and Fireblocks that have this established access. I think it's a real opportunity for these firms, for instance, for like us, to give you a quick example, to build on something like an L2, which I think is very promising, and provide this sort of the same performant sort of derivatives trading experience, but now done non-custodial, which of course institutions love, right? Because there's less risk. You don't have to worry about hack risk. You don't have to worry about, well, hack risk in terms of the smart contract, but at least you don't have to worry about the exchange getting hacked per se, or the founders taking your money and running away, right? So we think the world is ready for that, and sort of we're sort of putting our money where our mouth is, and building towards that future.
Excellent. I think that's an excellent note to finish it on. So I just want to thank Fireblocks one more time for making this possible, and thank you guys. I know my head is swimming with all of the knowledge that you guys have dropped. If you'd be willing to come back and do it again sometime, I think that'd be fantastic.
Sounds good.
Thanks for having us.
Thanks for having us.
Bye.
Thanks very much.